again, your deal is going to be dependent on your investment objectives, what it is you're trying to accomplish, and different people will have different objectives. And I'll go into a very brief example in a minute when I'm talking about these charts. But it's also going to depend on your risk tolerances, right? How much risk can you stomach? That may depend on where you are in your life. If you're married with 5 kids and you're the prime breadwinner, well, you can't dive in the deep end and buy a storage facility and quit your job necessarily. You might have to take a different approach than you could if you were a 25-year-old kid with no wife, no kids, and could live on $1,000 a month, right? Like these life situations are important to consider when you're figuring out what kind of deal you can realistically chase down. And then lastly, your resources, right? And I'm not, I don't in any way want to come off as saying that someone with less financial resources can't do this, because you absolutely can. I've got students who have literally, after joining my program, they had 20, 30 grand total to put toward an investment, and they're killing it. They're going to have ROIs in the hundreds% over the next couple of years. So you don't need hundreds of thousands of dollars or even 50s of thousands of dollars to get it done. But if you've only got, say, 20 to 50 grand to go chase a deal, or maybe even no money, and you can do it with equity partners, that's just going to color what types of deals you're going to go after. It's not, can you do it or can't you do it? It's just, if you only have 20 to 40 grand, let's not go look at $8 million properties, right? Let's be more realistic and go look at some $200,000 to $500,000 properties as your starting point. So these 2 charts, excuse me, are, they represent 2 ends of a spectrum. I want you to think about this as like a double-sided arrow. And on one end, there's value add, and on the other end, there's turnkey, right? And I think we all know, I'm not going to berate this point, but a turnkey property is up and running. It's more or less been optimized, and it's kicking out cash. Because of that, there's a healthy income stream. Because of that, there's going to be a high price tag on that property. The returns can still be good, but generally speaking, at that end of the spectrum where you have a property that's well run, the cash flow is going to be there from day one, right? But it may be your ability to grow that cash flow and grow the equity in the property is going to be relatively limited, because, by definition, a turnkey property, the previous owner is the one who got it to the point where it is now turnkey. So there's not a whole lot of more room for improvement that you can force. Now, if you're in a market that is growing, you might be able to experience some appreciation, but that's more speculative in nature. You're not forcing that appreciation. You're just enjoying it because of what's happening in the market. And that's a viable strategy. It's just not the one that I choose. The other end of the spectrum, now, actually, before I go to the other end of the spectrum, let me tell you that I'm not knocking a turnkey investment, or, again, this is a spectrum. So it's not all or none. You may have value add on this side and turnkey on this side, and you just have to decide where on that spectrum you want to be. You could be right in the middle where maybe there's some cash flow and some room to grow. Whereas on the far end, the turnkey property is going to have really good, decent cash flow to begin with, but not a lot of room to grow. So at the other end of the spectrum is the value add property. And these are the ones you can see in the chart here, where the cash flow, the dark line, when we buy it, is negative. We're losing money when we buy this. And some people would look at that and go, well, that's a terrible investment. Well, it is if that's where it's going to stay, of course. But our investing strategy is to find these deals, identify why they're underperforming, and then ascertain if we can fix it. And if we can fix it beyond, we have the confidence that we can fix it beyond whatever threshold we set, then we can anticipate this cash flow can improve considerably. And this, to me, is where the real value is created, right? Because storage facilities are valued based on their income stream. So if you can vastly improve the income stream, you're going to get a more or less parallel increase in the equity. And so not only in this situation, you've got a property where you've massively improved the cash flow. You bought it for, let's say, 50 cents on the dollar. And then by the time you improve the cash flow and stabilize the property, it's worth double what you paid for it. And so your leverage is considerably less than a property most of the time that you buy turnkey, because you're going to leverage that at the bank and you can't get the equity to grow very fast because there's no room. It's already at its peak, if you will. So